Okay, so today we're diving into something that you might not think is super exciting on the surface.
Yeah,
But trust me, it's actually really important.
it is.
We're talking about debt pricing, how interest rates on loans are actually figured out, and this impacts you way more than you might realize.
Absolutely.
So think of this like a behind-the-scenes look at what makes some loans more expensive than others.
Yeah, it's really like a puzzle, really. There's
Yeah.
a lot of pieces
Right.
that fit together to determine that final interest rate.
Okay, so first things first, not all borrowers are treated the same.
Right.
It's like if you have a good track record,
Yeah.
get a better deal.
Think of it like a credit score for a company.
Okay.
But instead of affecting your ability to get a credit card,
Right.
it impacts their ability to get a loan
Yeah.
at a good rate.
Mm-hmm.
A big established company with a great history, what you might call a blue chip company,
Yeah.
is going to sail through with flying colors. But a newer company, or one that's had a few bumps in the road, might face higher rates.
Sure.
Lenders want to be confident they'll get their money back, after all.
That makes sense, but where do they even start with these rates?
Yeah.
Is there like a baseline number?
There is. It's called the risk-free rate.
Okay.
And it's basically the rate you get on an investment with theoretically zero risk,
Okay.
like lending money to the U.S. government
Oh.
by buying a treasury bond.
Wait, so you're telling me the safest investment in the world is lending money to the government? No offense to Uncle Sam, but...
Well, it's considered the safest
Mhm.
because the government is extremely unlikely to default on its debts. And this rate, believe it or not,
Uh-huh.
trickles down and affects everything else.
Okay.
You know how you've been watching mortgage rates lately?
Yeah.
Well, the starting point for those rates
Yeah.
is actually tied to what the government pays on its bonds.
Wow, mind blown. Okay, but we all know interest rates go up and down all the time.
They do.
What's driving that
Yeah.
roller coaster?
It's a combination of things.
Okay.
One big factor is market conditions, which is a fancy way of saying overall economic activity
Right.
and how much demand there is for loans if
Everyone-
businesses are booming. And everyone's looking to borrow, rates tend to climb.
Yeah.
And then there are things like inflation and what the Federal Reserve is doing with interest rates.
Uh-huh.
Remember that recent rate hike?
Yeah.
That sent shockwaves through the whole lending system.
Okay, I get that emotions can run high on the market, but how much does this overall mood really impact the cold, hard numbers?
More than you might think.
Really?
Investor confidence plays a huge role.
Okay.
If lenders get nervous, say there's a global event
Uh-huh.
or a company gets hit with a scandal, they're going to demand higher rates to compensate for that perceived risk.
So basically, reputation is money.
Pretty much.
Got it. But what about time? Does the length of a loan impact the rate?
For sure.
I mean, a 30-year mortgage
Right.
is a much bigger commitment than,
Yeah.
say, a quick 5-year car loan.
You're absolutely right. That brings us to something called the yield curve,
Okay.
which shows the relationship between interest rates. And the length of time money is lent,
Okay.
generally the longer the loan term, the higher the interest rate.
Right.
The lender is taking on more risk over a longer period. There's more uncertainty about what could happen in the future.
Yeah, that makes sense. It's like the lender needs a bigger incentive
Exactly.
to lock their money up for longer.
Yeah.
Speaking of risk,
Yeah.
what about the actual structure of the loan? Does all that fine print affect the rate?
Absolutely. There are two main types of loans,
Okay.
secured and unsecured. A secured loan is backed by collateral,
Okay.
something valuable the lender can seize. If the borrower doesn't repay,
Good.
think of a pawn shop loan.
Yeah.
Or a mortgage where the house acts as collateral,
Yeah.
since the lender has some protection. These loans usually come with lower interest rates.
Makes sense.
Unsecured loans, like credit cards,
Right.
don't have the safety net,
Right.
so they carry higher rates.
Oh, that's interesting. So it's all about how much risk the lender is willing to take.
Precisely. And to manage that risk,
Uh-huh.
lenders often use covenants,
Covenants.
which are basically rules or restrictions written into the loan agreement.
Covenants sound intense. It's like a whole legal battle
Yeah.
waiting to happen.
Sometimes it can feel that way. Imagine you're lending a large sum to a company
Uh-huh.
and you're worried they might go on a spending spree and take on too much additional debt,
Yeah.
making them riskier.
Right.
A covenant could limit how much more debt they can take on
Okay.
or require them to maintain a certain level of profitability. It's a way to protect your investment.
Sure.
And of course, loans with more restrictive covenants might have slightly lower rates. because the lender feels more secure.
That makes sense.
Yeah.
Okay, before we wrap up, I'm curious about one more thing.
Yeah.
Some loans seem way easier to trade than others. Why is that?
That boils down to liquidity,
Okay.
or how easily a loan can be bought and sold in the market. It's similar to trading collectibles.
Right.
A rare baseball card is much harder to sell than a common one. Right?
Yeah.
Same thing with debt.
Oh.
A highly liquid loan, like a widely traded bond,
Exactly.
is easier to buy and sell, which makes it more attractive to investors.
Yeah.
And because of that high demand, these loans might have slightly lower interest rates.
Wow, this has been a real eye-opener. We've gone from credit ratings and risk-free rates to market mood swings and the wild world of covenants. Who knew debt pricing could be so complex?
The key takeaway is that every loan has a story,
Right.
and the interest rate reflects that story,
Yeah.
encompassing risk, time, market conditions, and even investor psychology.
So here's a question for you, listener.
Yeah.
If you were lending money, what factors would you prioritize when setting the interest rate? Food for thought as you navigate your own financial decisions.